Hello, traders. Welcome to Simpler Trading. My name's Melissa, and in today's video, I'm super excited to talk about some easy chart patterns that I believe every trader should know. The good news is, whether you're just beginning trading or you've been trading for a while, what I'm sharing in this video, I believe, will be valuable information for you to incorporate into whatever trading strategy you're currently using. For those of you who don't know me, again, my name's Melissa. I'm a trader here at Simpler Trading. I trade in the Trendy Trading Room and the SPX Alerts Room with my trading partner, Trendy John. We have a great time in there. I believe you have found the right place if you have found Simpler Trading, because we have the absolute best community of traders out there. I know that I might be biased, but I truly believe that. And it's not just about those of us on this side of the mic, it's also about the community of traders that we have at Simpler, a great group of people, super supportive and very knowledgeable. So let's get started. Oh, thanks, Kat. Good afternoon. Glad you love my videos. I love doing them. I have a passion for teaching. And so I'm just blessed to be able to be a part of Simpler and share as I am able. So, saying that, just so you know, my appearance, my voice, all of that might be a little off. I do have COVID. I'm feeling better, but just so you're aware, if I have to take a drink or something during the video, I normally wouldn't do that, but right now I might need to. So let's get started talking about the easiest chart patterns every trader should know. Every successful trader learns one thing early, and that is that markets move in patterns, right? Wouldn't you agree? The market moves in patterns. The good news, you don't need to memorize hundreds of patterns. In this video, I'm going to show you the easiest chart patterns every beginning trader should master. Patterns you can spot quickly and trade with confidence. So stick around for the end, because not only am I going to show you how to identify the patterns, I'm also going to show you how I can use these patterns to create a trade plan based off of the pattern. And that is the most important part of trading in my book. I have a YouTube channel myself, and the name of it is Price Plan Profit. The reason why I chose those three words is because price action is what I use to trade the market, and then plan, because every trade should have a plan, and profit, because that's what we're all here for, right? But if you get the other things right, then I believe the profits will follow. So let's get started. What are chart patterns? Chart patterns are simply a visual way of showing how buyers and sellers are fighting for control. Think of it like this. Think of it as when you see a candle that is representative of price action, right? The candle is telling you where price is going at that very moment. Well, when a pattern happens, and the patterns I'm going to focus on today, I have chosen one, two, three, four, five, and six patterns that I want to focus on. And when you see these patterns, what you're really seeing is nothing more than a place where the bears and the bulls, or the buyers and sellers, are fighting for control. Once you understand these battles, you can predict where the market is more likely to go. So let's start with the first, and I think probably the most simple two patterns to recognize on a chart. I'm going to start with a double top. So if you're looking at my screen here, this white line across represents the double top pattern. The double top often looks like an M on your screen. So if you have a rally up, then a pullback, a rally back up to that top, this is the area that you're looking for a rejection. So a double top pattern on your screen is a bearish pattern looking for a rejection as price comes up here after a rally and consolidates, then has a breakdown. I draw a line across where that top existed, covering as many of these candles as I can in this consolidation period. I draw that line straight across, and when price comes back up to this area, creating a double top, this is an opportunity to look for a potential short in the market. So, a double top looks like an M and signals the price is likely to fall. Now let's talk about a double bottom. As you might guess, it is basically the opposite of a double top, right? So with a double bottom, you're looking for an area of consolidation and then a breakout or a move to the upside. You draw a horizontal line again. You want the line to capture as many of the candles in that consolidation as what you can. That's where I put the line. And then you're waiting for price to pull back and create the double bottom. And at this area in here, at that double bottom, that is where you are looking for price to move back to the upside. So a double bottom looks like a W and it suggests that price may rise. These are two simple and powerful reversal signals. Up next, I want to talk about the good old head and shoulders. I'm not going to lie, whenever I was new to trading and I heard people talk about head and shoulders, it took me the longest time to be able to identify this pattern on a chart. Now, of course, after many, 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 many hours staring at charts, they're much easier to recognize. But let's talk about the head and shoulders. This one is a very reliable reversal pattern. The head and shoulders, what you're looking for is basically three peaks. This chart pattern can occur on any time frame chart. The key with what time frame chart you're using is really dependent upon your expectations for the amount of time you're going to be in a trade. So, if you're a day trader or a scalp trader, you might be looking for a head and shoulders pattern on just a 5-minute chart. But if you're more of a longer time swing trader, then you might be looking for a head and shoulders pattern on a daily chart or a weekly chart. The time frame of chart doesn't matter. The pattern is valid on any time frame chart. The only thing that matters as far as the time frame chart you're looking at goes is the length of time you intend to be in the trade. So, like I said, to recognize a head and shoulders pattern on whatever time frame chart you're trading off of, you're looking for three peaks to the upside. The top peak represents the head. So if you were just to draw a happy face right around this top peak, that would be the head. And then one shoulder to the left and one shoulder to the right. These shoulders need to be basically in the same area. They can be off. It doesn't have to be exact, right? Nothing in trading is really exact. So it doesn't have to be exact, but you need the shoulders to be basically in the same general vicinity. So on this chart, we had this rally where we created a peak. We pulled back, looks like about 38.2%. Then we rallied again, creating a higher high and the head in this formation. When then we came back down, this created a double bottom here. If you notice from the other chart pattern, this would be a double bottom, right? Where we're expecting a rebound or a breakout. Then once we come back up to the level of the left shoulder, if price had pushed on through here, this would not have created a head and shoulders pattern. It would have simply created a double bottom, and then price would have went on to make higher highs. But because price stopped at this previous resistance area here, or this left shoulder, it created a right shoulder. So, a head and shoulders pattern, when you see these show up on your charts, what we are expecting is further downside. Now, later on, I will get into how to trade this pattern and I'll explain where the entry would be and all of that, and also where your stops would be to help you understand how to trade the patterns once you recognize them. So, to recap, a head and shoulders pattern is a three peak pattern with the middle peak being the highest, creating the head, the two peaks on either side being virtually in the same area, and this is a bearish pattern. All right. Next up, inverse head and shoulders. So, same concept, except this time you're looking as if this person's head is upside down. So, you can see here we made a lower peak down here. Then, after doing a little consolidating here, we get that breakdown that created a left shoulder. We get that breakdown, right? Then we come down, we create another pivot lower, creating the head. Once we come back up to this left shoulder or this previous swing high, if there is a rejection there, that creates your second shoulder. Now, what you're looking for is this a double top pattern? You see that double top pattern, which would be a bearish setup, or is the price going to close and hold above this inverse head down here? If it does, and then we rally off of that, then this is an inverse head and shoulders pattern, and this is a bullish play to the upside. All right. Any questions so far? I don't want to leave y'all behind. So, the inverse head and shoulders, the opposite is true in a downtrending market. So, a head and shoulders occurs in an uptrending market and it's signaling a potential reversal to the downside. An inverse head and shoulders typically shows up in a downtrending market and it is signaling a potential change in trend to the upside. The pattern often signals the end of selling and the beginning of a rally. It's one of the clearest signs of a trend change. All right. Up next, I want to talk about a bullish flag. Now, this one for me is, or whenever, even when I was a new trader, was easier for me to recognize. What you're seeing here with a bullish The flag patterns, both bullish and bearish, are showing strong momentum, then a pause, and then potential continuation. So, when looking for a bullish flag, the first thing you want to see is a nice, powerful rally. That is creating the flag pole, right? You see it? And this is a flag pole. Now, granted, it's not straight up and down because the market doesn't often move straight up and down. But here is your flag pole. Then, like I said, after a nice rally, you create the flag pole. Then you get a consolidation period. What you want to do is you want to draw a trend line on the highs and draw a trend line on the lows. When identifying a bullish flag pattern, what you want to see is for price to break above the top trend line. That is a strong indication of bullish momentum and where I'm looking to buy calls once that top of the flag is broken. So, a bullish flag is a indication that there is strong momentum to the upside and a potential for continuation to that upside. All right. Hi, Anna Marie. Good to see you as always. All right, let's talk about a bearish flag. Now, a bearish flag often occurs, right? After we have made a pivot high, there's an area of consolidation. Then you get a sudden move to the downside. That's going to create a flagpole as well, but this flag is upside down. Okay, it's just the opposite of a bullish flag, but the exact same concept, right? So, this swift move, these often happen very fast with not a lot of pause in between. So, you get the flagpole here, the swift move down, and then you get a period of consolidation. Just like with the bullish flag, what you want to do is you want to draw a trend line that covers across the top, so across the highs of these candles and the lows of these candles. It creates this flag like pattern here. Now, on a bearish flag, because the flagpole is going down, right? A bullish flag, the flagpole's going up, bearish flag, flagpole's going down. What you're looking for here is for the bottom trend line to be broken. That is your indication of a continuation in momentum to the downside. All right. Any questions so far about that bullish and bearish flags? Thanks, Chris. Appreciate you. And hi, John. Thanks. Yeah, it's nice to be back after vacation. Thank you so much. All right, let's talk about how to trade these patterns. It's cool to be able to recognize patterns on a chart, right? But what is even better is to know how you're going to trade these patterns. And I just want to give you an idea of how I personally would trade these patterns. Now, I got to mention here, I did not include this chart pattern in this video, but my go to chart pattern is the inside candle. I have a video on my YouTube talking about that inside candlestick pattern, and it's actually the candlestick pattern that for the last 3 years has shown up in over 80% of my trades. It is my go-to candlestick pattern to trade. So while I might not be actively trading these candlestick patterns that I'm talking about, I can easily identify them on a chart and can trade them based on what I know about them. So let's first talk about the double top or double bottom because this is actually a chart of, I believe Amazon is where I got this chart. So let's first talk about the double top. Right here, like I said, a double top is created when you've had a rally, a period of consolidation, and then a downturn. All right, this created your top. You draw your horizontal line across, and you're waiting for price to come back up to this top. Remember, with a double top pattern, right? We're looking for downside plays. So for me, because I am a directional options trader, that means I'm going to be buying puts at a double top if I want to short this name. All right. So my entry would be set right here at this double top. Now, you can't just know where you're going to enter a trade, right? You also need to know what is your risk? Where is your stop? Where is it that you're wrong on the trade? That's very, very important. So, with a double top pattern, I place my stop at the pivot high of this pattern. In this case, right up here, this swing high, that would be my stop. So I'm entering on the test of this double top. Now, if you want to take a conservative approach, what you can do is once this top is tested, you're looking for candles to create lower lows and then a break back down below that top. That's your entry. The stop again is the pivot high up here. You set your targets to the downside, and then you have a trade plan. You know where you'll enter, you know where you're wrong on the trade, and you would take a stop, and you will know where your target is at. Now let's talk about how I would trade a double bottom. Same concept. I'm going to run my horizontal line across after a rally followed by consolidation and then a continuation move. I run that horizontal line across these this consolidation area before that breakout. And when price comes back to and creates a double bottom, I'm looking to enter to the upside, or for me, that would be buying calls. My stop is, as you could probably guess, this pivot low or this swing low. This bottoming wick indicates buying pressure. That's what I want to see when I'm entering a bullish trade. So my stop would be a candle below this pivot low. So now on the double bottom, pattern, I have my entry, which is a pullback to that previous low. I know where my stop is or where I'm wrong on this trade. Sorry. Apologies, guys. That's my biggest pet peeve when I'm on the mic. So I apologize. This is where I know that I'm wrong on the trade. That's my stop. And of course, I have my target right here. So as you can see, this trade playing it both to the upside and to the downside would have worked out. Um, and it's pretty cool little pattern that is to me very easy to identify. You can use it on any time frame chart, and it gives you both a bullish play and a bearish play. So a double top is when you're looking for downside price action, and a double bottom is when you're looking for a rally or upside price action. Now let's talk about how I trade the head and shoulders pattern. So again, here's our head and our two shoulders. All right. The area right down here, if you were looking at this as a person that's shrugging their shoulders like this, right? Where that neckline is, that is your entry for a short. Remember, I said earlier a head and shoulders pattern is a bearish pattern. So, this is the entry for the short. Once price breaks below the neckline, you're wanting to go short. However, you do that. For me, that would be buying puts. And as far as my stop goes, I use the line of the shoulders as my stop. And then I would use another candlestick pattern. More than likely for me, that would be the inside candlestick pattern to set my targets. And I would have a trade plan based on the head and shoulders candle pattern, which again is a bearish pattern. Now let's look at the inverse head and shoulders. All right, same concept. Here is the head. Here's your two shoulders. The neckline is above the head for an inverse head and shoulders. And what we're looking for is when price breaks above the neckline, we're looking to go long and playing a reversal to the upside. Again, my stop is a candle below the shoulders here. I would be wrong on this trade if I entered right here if a candle came back down below the shoulders. So, inverse head and shoulders, you know where you want to enter is a break above the neckline. You know where your stop is. It would be a candle below the shoulders, and then you set your targets based on candlestick structure to the upside, and you have a trade plan. All right. Now, let's talk about the bullish flag. Again, here's your flag. For a bullish flag, the entry is the break above the upper trend line. That equals you're going long. And as long as once price breaks above this top trend line, you are long as price does not come back down here and close below the bottom trend line. So you have a defined risk. You want to go long above the upper trend line and you want to set your stop. For me, I use a candle close below the lower trend line, and you're playing this up to your targets. So that's how I trade a bullish flag. Now let's talk about the bearish flag. Same concept, just opposite. I want to short a break of this bottom trend line. Once price breaks below here, I am buying puts and my stop is a candle close above the top trend line or the trend line of the highs. All right. So I know where I want to enter, which is a break below the trend line. And I know that my stop is above the upper trend line. And that is how I would trade a bearish flag. Pretty cool, right? All right. So I have talked to you about how I recognize these patterns. But don't just memorize these patterns. You need to practice spotting them in real time and combine them with proper risk management. Define your entry, define your stop loss, and your targets before placing any trade because that's how patterns become profits. Now, these are the easiest chart patterns I believe every trader should know. If you start with these, you practice, you'll see the market differently. So, that is my time. I hope you learned something here or at least I reinforced what you already know. I mentioned that I have my favorite candlestick pattern to trade, the inside candle. I'll make sure in the comments I link that video to the comments of this video. So if you're interested in watching that one, you can learn especially how I set my targets if I'm trading one of these simple candlestick patterns. But again, I invite you, join me, join Trendy John in the Trendy Trading Room. We right now have a 30-day trial for only $7. So if you're not a member of the Trendy Room, don't wait. Hit the link in the description of this video and you can come join us, hang out with our trendy family, and see us trade in real time. And guys, I don't like to brag, it's not who I am, but John and I consistently are winning trades over 80% of the time. And not only that, but we have the absolute best community of traders there. So please join us in the Trendy Room if you haven't checked us out before. And I look forward to seeing you in the next video. I hope you all have an awesome day.